Okay, hello and welcome back to Patrick Boyle on Finance. So in today's video, we're going to talk about the Bank of England's forecast stating that the coronavirus epidemic is likely to push the UK economy into its deepest recession in 300 years, and their decision not to provide any new stimulus right away. Okay, so the Bank of England in its monetary policy report this morning put forth their predictions for the UK economy. They suggest that output has fallen 3% in the first quarter and that there'll be a 25% drop in output in the second quarter, which compounds out to an almost 30% drop in the first half of 2020. That would be the fastest and deepest recession on record since the Great Frost in 1709. Now, the Great Frost of 1709 saw 3 months of deadly cold that led to a year of famine and food riots in Europe. So quite a significant event. Everything turned to ice, lakes and rivers and seas froze, the soil froze to a depth of about 1 meter or more, livestock died from cold in their barns, and travellers froze to death on their roads. So, you know, that is a rather significant type of event that this is being compared to. Now, the last time that we've had an annual drop in real GDP of more than 4.5% was in 1945, and the last time that we've had a drop in real GDP of greater than 10% was 300 years ago in 1709, a bit over 300 years ago. These economic projections came with a warning to Britain's banks that if they tried to stem losses by restricting lending, that they would only make the situation worse. Andrew Bailey, the Bank of England governor, said that a failure to lend would create a vicious cycle of more bankruptcies and higher losses on loans that would come back to hit the banks themselves. Mr. Bailey said that the better path for banks is to keep on lending. If the system ensures a good supply of loans, that we'll get a better outcome. So that's kind of the statement from the Bank of England. Commercial banks responded to this announcement by saying that they were committed to lending throughout the crisis. The Bank of England, in addition, warned that even with adequate lending, the economy was bound to take a big hit. Household spending has already dropped by about 30% since early March. In addition, the central bank forecast that the UK's employment rate was likely to rise to 9% by next year, even with the government's job retention scheme in place, which is protecting many employees from being laid off. That would mean a higher rate of joblessness than after the 2008 credit crunch. They forecast that inflation would dip to 0.5% in 2021 before returning to the 2% per year target that they have the following year. On a more positive note, Mr. Bailey said that the economic rebound was likely to happen much more rapidly than the pullback from the global financial crisis, and that they assume long-term damage to the economy would be only 1.5% of GDP coming from missed business investment in 2020. Otherwise, the prediction is for a V-shaped recovery. Bailey defended the decision not to take more immediate action, saying that the measures announced in March had still not been fully exhausted and that they've made a very clear commitment to do whatever it takes to support the economy, consistent with their inflation target. All Monetary Policy Committee members agreed that more stimulus might be needed in the future, and the central bank is signalling that more quantitative easing is in the pipeline. The Bank of England, in addition, analysed if the financial system could cope with this type of recession, with the recession that they are predicting. And they said that banks will lose less money than in their latest stress test, and that the core banking system does have capital buffers that are more than sufficient to absorb losses. The Bank of England did stress that the pandemic would severely hit corporate cash flow. Government support would plug some of the gap, but there remains a $60 billion additional deficit that banks would need to cover in order to stop viable businesses from going under. The central bank warned that if banks failed to provide credit to their business customers, that they might see a short-term benefit in reduced losses, but this would just cause more companies to fail, unemployment to rise another 2%, ultimately leading to larger losses overall. So that's it for today's video. You made it to the end, so you do have to hit the like button. Please hit the subscribe and the bell buttons if you'd like to be notified of new videos as they come out. Let me know what you think of the Bank of England's announcements and predictions in the comments section below, and see you again soon in another video. Bye.